real estate has experimented with a whole lot of new concepts. The latest one is fractional ownership of commercial spaces. What exactly is fractional ownership? How is it different from other forms of investment like crowdfunding or REITs? In a market like India, where trust deficit is high and institutional mechanism is low, will a loose mechanism of fractional ownership actually gain ground in this country? Well, to know all this today, I have with me Mr. Amit Goenka, MD and CEO of Nisus Finance. Welcome, Mr. Goenka. Should we start now?
Yes, sir.
So, what is your outlook on fractional ownership of commercial spaces? Is it really gaining ground in India?
I have to say that fractional ownership model, which started more as an experiment almost 3 years ago, today has become quite a central asset class amongst the HNI segment. If you look at the total portfolio of most of the fractional ownership companies, which started with 30-40 crores, have grown to over $100 million each, which means that today the total size of the fractional ownership market amongst the top 4 operators is roughly about $400 million. That's a very significant size if you see that the ticket size of each owner or each participant is between 5 to 10 lakhs, which means that a large number of investors across the country have actually participated in this portfolio of fractional ownership. And if you also look at the outlook that these people have shown, or even the returns that they have generated, I think they are now looking at almost double-digit returns. They started with late single-digit returns of 7, 8, 9%. Today, with the escalation in prices, with increase in rents, because they got in at the time when it was COVID, they locked in transactions in around 2020, and those who got in that time, I think today are looking slightly better in terms of their returns. And obviously the underlying asset classes that they have is, so they've got into warehousing, not just commercial spaces, but also within the commercial portfolio, they've also got into logistics and warehousing spaces, which is, I think, a very robust asset class. And the demand for warehousing, as we know, continues to be very, very strong. And they're giving good returns. So I think it's a very serious mainstream investment opportunity today for most of the small investors who are looking to invest, smaller amounts of money into a real asset class, but in a financial way. So it's converted itself into a financial asset class. And of course, it's obviously performing to some extent better than REITs if you take away the capital gains and if you only look at yields. So REIT yields are about 7.5%, whereas fractional ownership returns are almost about 8.5%, 9%. So they're actually slightly better than REITs in terms of net yields. Of course, the returns on REITs have been better because of the upside in the capital value or in the trading value of the units of REITs. But notwithstanding that, I think as a management, because they've gone in a very focused way, looked at very select asset classes or select properties which are doing well, likely to do well. So it's a very targeted investment. And because of it being a targeted investment, it's done well.
ROI is just one part of the story. So conceptually, how is fractional ownership different from REITs and crowdfunding?
Correct. So one, it's very, very different from REITs. It does not follow any of the REIT norms. Now, REIT norms are very well settled. If you look at the REIT regulations as promulgated by SEBI, where you need to have an investment manager who has a certain pedigree of investment. Second is that it has to have a certain size. You can't do less than 1,000 crores of REITs, which means it needs to be grade A commercial properties of at least 1,000 crores in value, which are largely rent generating and stable assets. So REITs comprise of effectively grade A asset classes. And B is that REITs obviously have a certain regulatory framework around them in terms of dividend distribution, in terms of leverageability, in terms of offshore leverage availability, tax benefits, pass-through benefits, etc., which is not available obviously to the fractional ownership model. They're being run more like a private portfolio rather than a regulated portfolio. So REIT is a regulated portfolio which is tradable, exchangeable, has a certain NAV. All those regulations are not being applicable, are not applicable to a private portfolio, which is a fractional ownership. It is certainly a crowdfunding platform, effectively, and which is why they are largely all falling under the sandbox regulations of SEBI. They are not under the AIF regulations. They are not under the REIT regulations. As a tech firm, they're trying to fall under the sandbox regulations, which allow new companies to experiment with technology-based investments. Now, the problem with that is that, of course, and as you rightly brought up, in my view, eventually they should either fall under the REIT guidelines or they should fall under the AIF guidelines, because there needs to be a regulatory framework to protect the underlying investors, which today does not exist. So if tomorrow, if the valuations are bad, or if there is a crash, or the underlying has been bought at a higher price, or the dividends are not distributed in time, or whatever happens, I mean, there are no regulations which actually govern the application and management of a fractional ownership portfolio, and that is the inherent weakness, I think, today in these models.
You have touched upon a very important point. In a market like India, where trust deficit is high and institutional mechanism is low, do you think fractional ownership will actually gain ground among the small time retail investors?
See, as I was telling you, Raviji, that in the last 3 years, it has grown very, very rapidly, almost 300-400% a year, which is why starting from almost just a 50 crore investment almost 3.5 years ago, they've almost touched 500, 600. So it's been 10x. Most of the portfolio has grown 10 times in the last 3 years. Now, that could not have happened without retail participation. So clearly, retail participation is very high. It's being actively distributed by many wealth managers, independent financial advisors. Many people have been sort of doing peer-to-peer sales as well. So it has gained some amount of credibility. Having said that, I don't think it is a widely available product, because it's all done on a deal-by-deal basis. Unlike a listed security like REIT, which is a wider participation, this is not meant for a wider participation. So it's still a private portfolio. So, I mean, if you look at it, it's still very small compared to the REITs available in the country or the AIFs available in the country. But as an asset class, it still sustained itself. And I think that's important. I think we should have seen some failures in the first 3 years, but we haven't seen those many number of failures in the first 3 years. So of the concept having been brought into the market. So to that extent, I think there is some sustainability. But the challenge still remains is that the regulator will take cognizance of it now that it is gaining a certain amount of size. And regulators are obviously more reactive than proactive, as we know. So when they started by, starting under the radar in basically some fringe regulations of Companies Act or fringe regulations of SEBI. But today, now, if it's becoming a main asset class, I think it is time that the regulator will take cognizance, like we saw in the case of P2P lending. P2P lending also in the fintech space started as an unregulated product. Eventually, they were all required to become NBFCs and get regulated by RBI, and the entire space transformed, therefore. And I see a similar outcome also going for these, where they may be either required to convert to REITs or become AIF funds, which means that the smaller investors may not get to participate if they are in AIF, because then it will be 1 crore ticket size, or they will not be, or they will have to fall under the REIT regulations, which will need to be modified for smaller portfolios to get listed.
Finally, what would be your advice to the retail investors, whether they should go for REIT or they should go for fractional ownership?
So I think fractional ownership is for the more risk, taking investor, and not for the risk averse investor. Risk averse investor would be better off investing in a REIT. It's a very mature product. It is very well established. It has got only the largest players like Blackstone and obviously the counterparties like KKR, etc., which are part of Brookfield, which are part of REIT. So it's a very, very mature, very institutional product, very well regulated by, and we've got obviously global investors. So the outlook for REITs is obviously very strong. So if you're a risk-averse investor, a defensive investor, and is happy with a regular income of 5-6% plus some potential upside, which may take you to 10-12%, then I think REIT is a great option. It's liquid as well to some extent. However, if you're a more aggressive investor, then fractional ownership makes sense, because the fractional ownership operators are likely to generate better returns to be able to compete with REITs. Now, of course, there also lies the risk that they're unregulated. So there's also loss of capital, which may be possible. There may be loss of erosion of value, which may be possible. If you're a more If you're a more, if you're risk averse, do REITs. If you're likely to, generate, if you think you will generate higher returns and you want to effectively diversify with a specific operator, then certainly one can look at fractional ownership. But I think most people, a lot of the people who are actually investing in fractional ownership, Raviji, I've seen are the more young investors or the mid-income investors, or rather the middle management investors who are having a higher risk appetite. So people who have talked to me, who've asked me about investing, who've gone ahead and invested, if you see, they are not the retirees. They are not the people who are senior executives. They are not very large HNIs or family offices, because they don't participate in fractional ownership. They're largely the younger investor, the more bold investor, people who are willing to experiment with small amounts of money and try and get better returns, are the people who are mostly targeted by a fractional ownership model.
You mean to say this is like a gamble in the stock market, where if you have the risk appetite, then you go for penny stocks or you go for blue chip stocks? Is it like that?
I wouldn't say that honestly, because the good part is that unlike capital markets where it is purely basis a certain calculation of revenue or a certain performance of a company, and one can't say what is going to happen with that company. Here, the underlying is a very solid asset class. So whenever a fractional ownership uh, investment is offered, it is on the back of a identified asset, either a warehouse asset or a commercial asset, and one has the ability to understand that asset, and there is a certain fundamental capital protection involved in that asset. So today, if you're buying for 100 rupees, for example, that asset, and it is generating 6 rupees or 7 rupees in rent, now that 100 rupees will never become 50 rupees, because the replacement cost of those assets are actually very high and only going up by the day. So at least to that extent, I believe there is some amount of capital protection. It may not be 100% in the worst case scenario, because the liquidity of these assets are very low, and it may not be easy to flip a strata product, because remember that fractional ownership is effectively strata buying. You're not buying the whole building. You're buying one office occupied by somebody. You're buying a part of a warehouse. So strata sales are usually difficult. They're not never bought by institutional investors. It's usually bought by the HNIs or family offices, etc. So it's slightly more illiquid. Now, because of that, there may be a discount if one has to sell it in a stress scenario. So 100 rupees may end up getting sold at 85 rupees or 90 rupees. So to that extent, there may be some capital value erosion in the worst case scenario, but at least even to that extent, your principal is protected. So 80-90% of your principal is protected at all times. I think that's a very important aspect of, of, of it being real estate backed as opposed to, the stock market. So I think that's an important thing. And I think that is obviously a very big factor also for investors, because they know that to a large extent their capital is protected, because they're getting into. And of course, the other thing what is important is that people who are investing into fractional ownership should have some understanding of real estate. In REIT, you don't need to understand real estate. You're basically going after a very large listed security which has performed for itself and which is backed by institutions. But in fractional ownership, it's like I would want to buy an office which is pre-leased. It's going to cost me 2 crore rupees. It's going to generate 6-7%. I don't have 2 crore rupees. I only 20 lakhs. I can still participate in buying that office. So it is effectively a investment for the real estate lover, for a person who understands real estate, has the capability to due diligence it, verify it, understand the economics of it, understand the risk factors for themselves, and then invest. So it needs a certain amount of engagement with the sector to be able to invest. It is not purely a financial investment. If somebody is assuming it's a financial investment, then it's a wrong notion, because REIT is a financial investment. This is more a underlying asset class investment.
Thank you, sir. Has been Mr. Amit Goenka, who thinks fractional ownership has a great future in this country. The real underlying issue today is to evolve a safety mechanism around this new product, to make it foolproof, to create an institutional mechanism where an average investor feels safe to invest with fractional ownership. Going by the experience in this country, most of the financial products have evolved. Fractional ownership has just gained ground in India, and it is to be seen what kind of institutional mechanism is provided to make it a sound advisable investment.